America's economy is unraveling from the inside out. Over 1 million jobs have vanished in just 10 months. Consumer confidence has crashed to 50.3, and the federal government itself is shut down, the longest in U.S. history. Key agencies are dark, data releases frozen, and millions of workers left unpaid. Wall Street insists it's a soft landing, but Main Street is collapsing in silence. Prices rise, layoffs multiply, and policymakers operate blind. When a $27 trillion economy can't even keep its own government running, the warning isn't theoretical, it's terminal. America isn't managing a slowdown anymore. It's managing a breakdown. The foundation of the U.S. economy isn't factories or markets, it's confidence. And that foundation just cracked. The University of Michigan's latest data shows consumer sentiment has plunged to 50.3, a level not seen since the inflation panic of 2022. Across every demographic, Americans are losing faith in their financial future. Buying conditions for essentials and durable goods are collapsing, not because prices rose overnight, but because people simply stopped trusting the system. Real wages remain flat, savings are evaporating, and credit card balances have soared past $1.4 trillion, the highest in history. This isn't a normal slowdown, it's an emotional recession. The perception of risk now outweighs reality itself. When confidence dies, spending dies. And when spending dies, the U.S. economy, 70% powered by consumers, begins to suffocate. Every statistic reveals the same trend. People are saving out of fear, not strategy. Inflation may have cooled on paper, but the psychological inflation, the belief that everything costs too much, is accelerating. The average American doesn't see a recovery, they see fragility. The illusion of stability is gone, replaced by quiet panic that's now spreading faster than any virus ever did. Confidence didn't collapse in isolation. It fell alongside the single most alarming labor trend of the decade. The United States has entered what analysts now call a silent employment crisis. In just the first 10 months of 2025, more than 1,017,000 job cuts have been announced nationwide. That's a 45% increase compared to last year, and the worst pace of layoffs since 2003. What makes this different from past recessions is the speed and breadth of the decline. No sector is safe. Tech companies once hiring tens of thousands are now erasing positions by the hour. Warehouses that expanded during the e-commerce boom are shutting down entire shifts. Retail chains are downsizing even during the holiday quarter, the time when hiring should rise, not vanish. October alone saw 153,000 announced layoffs, a 175% year-over-year surge. This isn't a market correction, it's a systemic contraction. Every job cut reduces spending power, and each lost paycheck magnifies the emotional recession described earlier. The data confirms what ordinary people already feel, that the so-called strong labor market is little more than an echo from 2021's recovery. Behind every percentage point drop in confidence lies 1,000 pink slips. Corporate America is now operating in survival mode, with input costs up 11% since 2022 and borrowing rates still above 7%. Profit margins have vanished. Employers are trimming labor not to grow leaner, but to stay alive. Challenger, Gray, and Christmas reports that more than 70% of companies cutting jobs cite rising operational costs and reduced consumer demand as their main reasons. Not innovation, not strategy, but pure economic strain. And the real danger isn't the layoffs already announced, it's the ones still hidden in balance sheets. Businesses are delaying cuts to avoid panic, yet temporary contracts aren't being renewed. Overtime hours are slashed, and hiring freezes are spreading across logistics, manufacturing, and finance. The illusion of job stability is gone. What's forming now is a labor vacuum, a hollowing out of America's workforce that will not be reversed with another stimulus or soundbite. The employment engine that once powered confidence has stalled, and the silence of lost paychecks is echoing louder than any political promise. The layoff wave is not only about weak demand or corporate cost-cutting. It's about a new form of disruption reshaping the job market faster than policymakers can comprehend. Artificial intelligence, once hailed as America's next economic miracle, has become the silent executioner of millions of livelihoods. Companies across the tech, finance, and service industries are deploying automation to slash payrolls, not expand productivity. AI systems that cost a few $1,000,000 to build now replace entire departments once paid $20 to $30 million annually in wages. This is not efficiency, it's displacement at industrial scale. In 2025 alone, U.S. corporations invested more than $400 billion in AI infrastructure, data centers, and software systems. McKinsey projects that number could exceed $2.9 trillion by 2028. But those trillions aren't generating new jobs, they're eliminating them. Tech firms, call centers, accounting divisions, and even marketing agencies are shedding positions that took decades to create. The logic is simple. In a high-cost, low-growth economy, labor is the easiest expense to erase. For executives under shareholder pressure, automation isn't optional. It's survival. The paradox is that while AI is marketed as the future of innovation, it's accelerating economic contraction today. Productivity gains at the corporate level are colliding with unemployment spikes at the national level. Every robot, algorithm, and automated workflow extracts disposable income from the economy, shrinking the very demand companies depend on. This is how innovation becomes self-destructive. The same technology meant to drive prosperity is quietly draining it. Employment in administrative, support, and customer service roles has fallen by 12% since late 2023, the steepest decline since the 2008 recession. White-collar displacement has entered mainstream industries once thought immune. Even large retailers and logistics firms now use AI scheduling systems to cut human shifts by 20 to 30% without publicizing layoffs. What looks like operational efficiency on paper is actually hidden unemployment spreading beneath the surface. This explains why the confidence crisis and employment collapse are deeply connected. Workers are realizing that their competition is no longer another person. It's an algorithm. The promise of progress has turned into an economic divide between those who build machines and those replaced by them. AI isn't just transforming business, it's redefining human value in America's collapsing labor economy. What began as temporary belt-tightening has now evolved into a structural reset of corporate America. Companies are no longer cutting jobs to weather a storm. They're redesigning their entire operations for a permanently weaker economy. In the first 3 quarters of 2025, S&P 500 firms collectively reduced labor expenses by $92 billion, the largest contraction since records began. Profit margins have fallen to 8.1%, down from 12% in 2021, forcing executives to prioritize survival over expansion. The pattern is visible across nearly every major employer. Amazon has eliminated 14,000 positions, streamlining logistics centers that once operated at 120% capacity during the pandemic. UPS has axed 34,000 operational roles, citing automation efficiency and reduced shipping volumes. Target slashed 1,800 corporate jobs, while Paramount Skydance merged departments to remove 1,000 staff. Even resilient giants like Starbucks, Delta Airlines, and CarMax have initiated corporate downsizing. The numbers reveal the shift isn't cyclical, it's strategic. Labor isn't being paused, it's being erased from long-term planning. Rising input costs compound the pressure. Fuel, shipping, and wage inflation have raised operating expenses by 9.8% year-over-year, while corporate debt now exceeds $13.5 trillion, a record burden in U.S. history. Refinancing at higher interest rates has become unsustainable, leading to what analysts call silent bankruptcies, closures disguised as restructuring. Businesses are quietly exiting low-margin sectors, consolidating roles, and outsourcing to AI-driven contractors that never demand benefits, health insurance, or weekends. This transformation is reshaping the American employment model. Stable salaried positions are vanishing, replaced by contract work and algorithmic management. According to Labor Department estimates, nearly 1 in 4 U.S. workers is now classified as independent or temporary, a figure projected to hit 30% by 2027. Job security has effectively become a historical term. The implications extend far beyond unemployment figures. Each eliminated position represents less consumer spending, less tax revenue, and more dependency on credit. The feedback loop is brutal. Falling confidence leads to layoffs. Layoffs shrink demand, and weak demand triggers even deeper cuts. Corporate America has entered a phase where growth is no longer the goal. Endurance is. The US economy isn't merely slowing down. It's restructuring itself into a leaner, colder version of capitalism that measures progress not in people, but in costs removed. The corporate reset is feeding into another brutal signal: retail collapse. When the consumer stops spending, the entire economy loses oxygen. The latest data shows retail sales falling 2.7% year over year, the steepest contraction since the pandemic lockdowns. Major chains are posting their weakest holiday forecasts in a decade. Inventory levels have surged 18%, while store traffic across malls and big-box retailers has dropped by nearly 22% since spring. This isn't seasonal fluctuation. It's a structural breakdown in demand. Consumers are retreating from the marketplace because they no longer believe tomorrow will be better. The average U.S. household is now spending $786 more per month than 2 years ago for the same basket of goods. Food inflation remains above 4.9%. Electricity costs have risen 13%, and auto insurance premiums have spiked 19% in the last 12 months. These compounding costs crush purchasing power. Even those still employed are cutting back. Spending on discretionary items, electronics, apparel, home decor, has fallen 8.2%, while essentials like groceries dominate every paycheck. Retail layoffs are confirming what the data already implies. Over 94,000 retail jobs were cut in the first 10 months of 2025, concentrated among companies once considered recession-resistant. Brands like Macy's, Kohl's, and Best Buy are closing underperforming locations, citing traffic normalization, corporate language for a customer exodus. The downstream effect is severe. Fewer store openings, smaller supply orders, and reduced manufacturing activity, creating a ripple that moves backward through the economy. This consumer retreat exposes the hidden truth behind the so-called soft landing. There's nothing soft about an economy where people cannot afford to buy what they once considered basic. Retail collapse isn't a side effect of layoffs. It's the confirmation that the middle class is imploding. The US economy runs on confidence, and retail is its reflection. When consumers hesitate, the entire supply chain convulses. Every unsold product represents not just lost revenue, but lost belief in stability. As consumer sentiment sinks below 55, the threshold historically preceding recession, the warning lights are no longer theoretical. America is entering a feedback crisis. Falling confidence drives layoffs. Layoffs crush consumption, and collapsing consumption fuels further job destruction. The shelves may still look full, but the buyers have disappeared, or easy eyes. And that silence is what economic decline sounds like. While retail collapses and corporate layoffs intensify, the federal government remains paralyzed. The ongoing shutdown, now the longest in U.S. history, has suspended critical data releases, frozen key agencies, and crippled the very institutions tasked with measuring economic reality. For over 8 weeks, official labor, inflation, and GDP figures haven't been published. Policymakers, investors, and analysts are operating in darkness, relying on fragmented private reports. America's economy is deteriorating without a dashboard, and the pilots are flying blind. The economic damage extends far beyond bureaucracy. Approximately 1.3 million federal workers are either furloughed or working without pay. That alone removes nearly $7 billion in wages per month from circulation, money that would have supported rent, groceries, and local businesses. Contractors depending on government projects are collapsing. Infrastructure maintenance, scientific research, and small business grants have all stalled, creating a backlog that will take months to repair, even if the government reopens tomorrow. The absence of data also distorts public perception. When Jerome Powell referred to the labor market as showing gradual cooling, it revealed the growing disconnect between official narratives and reality. Without accurate employment and inflation data, the Federal Reserve's decisions are guesses disguised as policy. Interest rates remain elevated, above 5.25%, choking credit access for households and businesses already under strain. Small business loan approvals have plunged 28% year over year, and mortgage activity has hit a three-decade low. This policy blindness intensifies the emotional recession that began with collapsing confidence. When citizens sense that even their leaders don't understand the numbers, fear becomes institutionalized. The shutdown isn't just political dysfunction, it's economic sabotage. It deprives Americans of truth at the moment they need it most. The combination of data absence, stalled paychecks, and high interest rates forms a silent shockwave across all sectors. Coherence between cause and effect is now visible. Declining confidence led to weaker spending. Weak spending triggered layoffs. Layoffs crushed retail demand, and the government's paralysis has removed any visibility of recovery. The United States isn't merely facing a downturn, it's facing a blind recession. One where leadership can't measure the fall, and ordinary citizens are left to feel it firsthand. Economic downturns don't begin in spreadsheets. They begin in the human mind. Fear is now the most powerful economic force in the United States. The latest University of Michigan survey shows that 71% of Americans expect unemployment to rise within a year, up from 34% just 12 months ago. This unprecedented shift in sentiment marks the transition from uncertainty to collective anxiety. When the majority believes the economy will get worse, that belief becomes a self-fulfilling collapse. Across households, spending patterns confirm the behavioral change. Personal consumption expenditures fell 0.8% in October, the sharpest monthly drop since 2020. Savings accounts are being guarded, not spent. Over $970 billion now sits in idle consumer deposits, while credit card balances continue to expand past $1.4 trillion, trapping millions in high-interest debt that exceeds 22% APR. Every dollar withheld from circulation magnifies contraction across the system. Fear has become the new inflation, invisible, psychological, and contagious. Corporations are reacting to that fear by cutting costs even faster. When businesses anticipate falling demand, they stop investing, reduce hiring, and limit wage growth. The result is a synchronized freeze where consumers refuse to buy, employers refuse to expand, and policymakers can't generate momentum. This cycle of mutual hesitation erodes the foundation of capitalism itself: trust. The economy doesn't collapse because numbers go down. It collapses because people stop believing those numbers mean anything. Social media and digital platforms amplify this uncertainty. Viral layoffs, price screenshots, and foreclosure clips feed a 24-hour loop of pessimism that reshapes behavior nationwide. It's not misinformation. It's magnified realism. People see empty stores, shorter shifts, and shrinking paychecks. Their perception of decline becomes identical to experience. The fear multiplier now spreads faster than any inflationary trend. It discourages risk-taking, undermines confidence in the dollar, and accelerates the shift from spending to survival. The collective American psyche has entered defense mode, not because people are broke, but because they believe collapse is inevitable. When 330 million citizens start preparing for the worst at the same time, that preparation is the worst. The invisible contagion of fear has replaced money as the dominant currency of the U.S. economy. Every chart, survey, and index now points to the same invisible collapse: the erosion of belief. The American economy isn't held together by production or policy. It's held together by trust. Without it, the most powerful system in the world becomes a machine with no operator. Consumer confidence is the oxygen of capitalism, and it's now below 55, the danger threshold historically preceding recession. When optimism falls beneath that line, spending contracts, investment freezes, and debt becomes heavier than growth. 70% of U.S. GDP depends directly on consumer activity. Nearly $19 trillion worth of transactions that only exist because people believe tomorrow will be better than today. Once that belief fades, the entire financial structure loses gravity. What's unfolding isn't just a downturn, it's a trust recession. A collapse in the confidence loop that connects workers, corporations, and policymakers into a single ecosystem. Every delay in wage growth, every missed sale, every broken promise accelerates the spiral. Meanwhile, the government's credibility is deteriorating at the same pace as the economy. Public faith in fiscal management has plunged to an all-time low of 16%, according to Gallup. With the national debt now exceeding $38 trillion and annual interest payments approaching $970 billion, Americans no longer believe Washington can manage stability. Financial institutions mirror that distrust. Deposit flight from regional banks topped $120 billion this quarter alone, as savers move funds into hard assets, commodities, and digital currencies. The dollar remains dominant, but its psychological supremacy is weakening. This disintegration of trust also infects the labor market and stock valuations. Employers hesitate to hire. Investors hesitate to reinvest. Markets surge artificially, not from real optimism, but from algorithmic momentum disconnected from real-world conditions. When confidence decouples from reality, both become meaningless metrics. The emotional recession has now matured into an institutional one. Every economic function, consumption, employment, production depends on faith in continuity. And that faith is evaporating. Capitalism doesn't collapse when money runs out. It collapses when belief does. America's greatest economic engine wasn't its corporations. It was the collective conviction that tomorrow would reward effort. That conviction has fractured. What remains is an economy still moving forward, but without direction. Sustained not by growth but by inertia, waiting for the next shock to finish what doubt began. The next phase of this economic unraveling will be defined by stagnation, not explosion. America is approaching a slow-motion breakdown where everything still functions. Banks remain open, wages still deposit, but the system underneath is hollow. History shows that when consumer sentiment remains below 55 for more than 3 consecutive months, recession follows with near certainty. The US has already been trapped below that line for 5 months straight. Every indicator, from job openings to factory output, confirms contraction disguised as resilience. The labor market, once celebrated as unbreakable, is deteriorating beneath the surface. Temporary and part-time positions now represent 28% of total employment, the highest share since records began. Real hourly earnings have stagnated at $11.42, even as living costs continue to rise. Corporate hiring freezes across tech, logistics, and manufacturing point to a grim reality. Growth has been replaced by maintenance. America is no longer creating jobs, it's recycling them. Consumer behavior reinforces this paralysis. Spending growth, once averaging 4% annually, has slowed to less than 0.7%, even before adjusting for inflation. Mortgage applications are down 61% from their 2021 peak. Auto loan delinquencies have surged 22%, and small business bankruptcies are up 34% year over year. These are not isolated trends. They're the footprints of systemic exhaustion. The US economy isn't contracting violently, it's decaying gradually. Meanwhile, corporate debt continues to rise as revenues shrink. Refinancing waves expected in 2026 could add another $1.2 trillion in interest costs, ensuring that even a mild downturn becomes financially catastrophic. The Federal Reserve, trapped between inflation control and credit fragility, has no path that avoids pain. Cutting rates risks reigniting price instability. Keeping them high ensures prolonged unemployment. Both options end in the same outcome, declining real demand and falling confidence. The illusion of recovery can persist only as long as people keep working through fear. But when the fear becomes normalized, productivity itself erodes. What comes next is not collapse in the cinematic sense, but erosion in the structural sense, an economy surviving on borrowed time, borrowed money, and borrowed optimism. America is entering an era where growth no longer feels like progress and stability, no longer guarantees security. The future of work, demand, and prosperity now hangs not on policy or innovation, but on whether a nation that has lost faith can still pretend to believe. The United States now stands at the edge of an economic identity crisis. Confidence has collapsed, jobs are vanishing, and the foundation of belief that sustained a $27 trillion economy is crumbling from within. The numbers no longer lie. They scream. 1 million layoffs, $38 trillion in national debt, and a population drowning under $1.4 trillion in credit card balances reveal a nation that has exhausted its margin for error. The illusion of endless growth has met mathematical reality. This isn't the end of prosperity, it's the exposure of fragility. Every paycheck, every policy, every promise now rests on borrowed time and borrowed trust. America's next recession won't begin with panic. It will begin with silence. When millions stop spending, companies stop hiring, and the belief that tomorrow will be better finally disappears. And when faith vanishes, the economy doesn't crash. It simply stops breathing.